Hello everyone. On my right, interest rates at their highest for 16 years. On my left, geopolitical tensions, rising interest rate volatility, the risk of recession, and central banks exiting their unconventional policy. So what are investors betting on? Attractive yields or fear of risks? A bit of both actually. They take measured risks, but above all, they expect to be paid in return. The market for new issues, called the primary market, shows us this through strongly positive concession premiums, unfilled order books, and even the withdrawal of issuers before the issues. Take the example of Acciona Energy, which despite a concession premium of more than 75 basis points over its existing debt, struggled to gather demand for its new green bond maturing in 2031. According to Bloomberg, this concession premium was 4 times higher than the average premium for 2023. And the situation did not end there, as existing bonds on what is called the secondary market have seen their premiums widen sharply. The premium on the 2030 Acciona bond rose from 116 to 167 basis points on the day of the announcement. In other words, its price fell from 95.5 to 92.20 over the session. More than a decade of central bank intervention, notably through bond purchases, has skewed the level of a market that no longer knows where fair value lies. On the other side of the Atlantic, the yield of the 10-year Treasury bond came close to 5%, a highest level in more than 16 years. So the experience of these levels is not engraved in the mind of less experienced investors, the same investors who have only very recently realized that bond prices can also fall, even if only temporarily. For many, therefore, this is an unprecedented situation. This paradigm shift is also reflected in the change in rhetoric. Many analysts are no longer talking about fair value, but adjusted fair value. A value that is not yet very clear and can be costly to find. Not paying enough can break a deal. Paying too much raises mistrust. Neither is desirable in an already nervous market. This mistrust can also be seen in the secondary market. More than half of the new bonds issued since mid-October have seen their premium widen. Whereas in the past, high concession premiums led to positive performance on the secondary market, this is no longer the case. In the first 3 days of the week of October 23, only 54 bonds were issued, compared with 123 same period third week of September. Issuers and investors are in an agreement. Now is the time to take measured risk while waiting for a clearer picture. Thank you.